This is why I think it's important to look at fixed strike vol every day now, because you have all these gamma models out there telling you completely different stories, right? You've got tier 1 alpha saying that books are now getting short gamma down here, right? You've got, I suspect spot gamma is saying something similar. You've got Nomura saying it's completely the opposite setup, where dealers are long downside and short upside. So they would actually be getting longer vol down here. And then you've got Goldman saying that local gamma is really high, and then on both wings, everything disappears. So who the hell do you want to listen to, right? The truth is, they all have their own assumptions and their own way they come up with that. And I'm not disrespecting any of them. I'm sure they do rigorous analysis and have their reasons for having their views. But the truth is, you need to look at the footprint. You need to look at the footprint that is being left on fixed strike vol surface to see if people are buying or selling options net. And if we get a spot drop of 1.6% and downside is red, that is telling me the street is not massively short that stuff, right? And doesn't feel stressed out and isn't bidding for vol. Now, we might have had some of this downside coming from the fact that vol was resetting lower after the FOMC, and it was a little bit elevated into that. So granted, that might be what's creating this down move. But, you know what I mean? It's not, for me, if those models that are saying that dealers' books have got short gamma were correct, I would have expected this stuff to be firmer in that move, and it certainly wasn't. So that's why I actually think this has to be a kind of, this is an important part of your toolkit if you really want to get an idea of gamma positioning and how that's going to impact markets, because this is the footprint. You need to see the footprint to then confirm or disconfirm your assumptions about gamma positioning, right? And that's why we provide this. And we provide it on the S&P because the S&P is kind of what's then going to, it kind of drives everything, right? It's the benchmark index. It's got the most options flow on it. And so if you can see the footprint in that market, then a lot of that translates through to other markets. Okay, that's enough of me, of my rant. So now finally closing off with the single stock strategy compass. Obviously, a lot of these names kind of come a bit more back towards the middle here after the sell-off. I've homed in on PayPal because it's got the most expensive vol in terms of its percentile ranges right now. You can see the stock has some pretty wild gyrations up and down, but it seems to be like, settling down a bit here. It's got some volume shelf support around.